Hello everyone, and thanks for tuning in to our equity index technical analysis for the week of January 11th to the 16th of 2015. This week we examined the reaction of the markets to overhead resistance and set up bearish trades to take advantage of this opportunity. For our paid market analysis live subscribers, we're also going to set up our full trade plans for Apple, Netflix, Amazon, and Baidu. If you'd like to sign up for a free 1-month trial of our weekly market analysis live webinars, plus receive a copy of our trading journal for free, click on the link below. Now let's get started. Let's start with our equity markets. S&P 500. How has it done this week? Well, it had an interesting week. Monday, it was a nice down day. Tuesday was a down day. I emailed you guys on Tuesday and said turnaround Tuesday can happen. I was wrong. It was turnaround Wednesday this week. Typically, the Tuesday is the day that you'll see a reversal in price, a little pop up before it drops again. This week it was Wednesday and Thursday. Two really bullish days coming in, took the price up, and on Friday on that horrible jobs report, you got a tweezer top here at a retracement level, and volume was high. So although the market looked slightly bullish by these two candles, look, it's still below this resistance. It's still failing at this blue resistance line, and it's really struggling to get to those new highs. All right, people are more concerned this year. And if you look at this, it's starting to look like some kind of pattern. What pattern is that, guys? If you connect this point, and this point, draw a trend line, and this trend line starts to look like something cool that we know. It's called a rising wedge. Rising wedges, not good. Okay, so we'll keep our eye out on that. We're going to delete this line just to clean things up a little bit. And we can start to draw this. Whoops. Alright, apparently we can't start to draw that because I can't click the mouse properly. This is beginning to look like a rising wedge. Each one of these highs is going not as high, and each one of these lows is continuing not as high as well. That totally didn't make sense. What I'm saying is each new high is lower than the previous one, and each new low is continuing higher. So these are actually consolidating and wedging and squeezing in here, and this expected breakout will be to the downside. So overall, yeah, the S&P 500 has done really great for a really long period of time, but the real test comes right now, in the next couple weeks. Okay, this resistance level in these 2 months here is going to be gold whether or not we break out, which would be this scenario, which I'd probably give it a 30% chance, and this one, which is 70% chance of 10 to 15% correction. Did you guys read the blog post? The 15% market correction blog post? Did you? We're going to have another one tonight. Did you guys like it? Do you like the new expansion in Market Analysis Live, the daily videos? Did they help you guys? It helps us be a little bit more agile and really to fight through the day in the markets, because if you just do it Sundays, it's not enough. You got to do daily updates. That's what I found. So everyone seems to be liking it. Okay, good. Only one of you read the blog post apparently. Jeez, takes a lot of time for one person to read it. Maybe you guys are just asleep for the rest of you, and that's totally fine. It's been a long weekend for me too. I went snowboarding for the first time in a really long time yesterday, and I feel beat up today. Like literally. Okay. I digress. If you map these resistances here and these supports on the Dow Jones, DGIA, same deal here, guys. Another rising wedge. All right. The only interesting thing about the Dow, obviously, is the fact that it's in the middle of a channel, so it's got a lot more upside before it gets to resistance. Whereas S&P, it's already hit it, failed a couple times, and it's in a really vulnerable spot. So the Dow's got a little bit more upside, and we find that interesting. Okay, I'm going to go back to S&P 500, and I want to look at the moving averages. The price, look at that. The price stops flat on that 50 MA. That's very important to notice. It's going to give us some support for the open tomorrow, and we're going to see this 2,044 point level is going to be a very strong battleground for traders on the open on Monday. Okay, that level is going to be the level where a lot of blood, sweat, and tears are laid out in order for the price to move up or down at this point. All right, if we look at the long-term moving averages, nice little bounce off the 100. Now you know why Wednesday went bullish. That was it. Okay, there was support right on the 100-day moving average. And momentum, however, It's still looking bearish. All right, I don't know how people don't see this and don't care about it, but prices are going up, momentum's going down. This is a divergence, and we know what a divergence means. The market's going to continue lower. Okay, so we're timing these for a sell-off in both S&P 500, Dow Jones, and NASDAQ. Okay, let's look at NASDAQ since we mentioned it. NASDAQ hit one top, hit two top. Previously, it hit this neckline. So what is the most common occurrence from a double top failure? What pattern could a double top become? There's really a couple possibilities. Number one and number two are the ones I want to talk about. What do you guys think? Okay, so here's a double top. The idea is that it breaks and continues lower, but it failed, so it continued up. So what could it really be? Sideways is one thing. Yeah, it could be a sideways trend. It could just continue in between these two boundaries. It could be a triple top, right? It certainly could. Or it could turn here and probably be even a head and shoulders. There's a lot of things it can be, and that's why we don't enter until the time is right. I will tell you this much. Should we get between 45, 50 or lower? We're going to go heavy on the puts on NASDAQ using the triple Qs. I can't wait. It's going to be a great trade if it does end up happening. If not, we'll even ride this. If we get 1, 2, 3, 1, 2, 3, whoops, that one should be up here. Well, that's a range, and that's a really exploitable and profitable trading range for us. Okay, so both CompQ, all three so far, CompQ, which is NASDAQ, Dow Jones, S&P 500, look vulnerable at their levels and look like they might go bearish. The US dollar, well, that continues its rapid ascent upward and in a bullish fashion based on risk appetite. People are hungry, or sorry, not risk appetite, a lack of risk appetite. What am I talking about today? Losing my marbles. The dollar goes up as risk increases. So if you perceive global risk to increase, the US dollar is most likely going to increase as well. Okay, because it enjoys a safe haven status. People find safety in the country that has the highest debt for some reason. Go figure. All right, that's today's world. There's your markets. There's a comparison of all equity markets, including the dollar index. Let's have a look at how gold is doing. And we're going to look at oil as well. I'm going to reorganize these charts for next week to have gold, oil, silver, and the US dollar, and then equity markets on one screen. So it's going to look a little different. Don't get too used to it. All right, gold remaining flat here. It's in between. It's in a little range that it's trapped. Some people see an inverse head and shoulders. I would agree with some people. It could certainly be an inverse head and shoulders, at which point you want to see a bar break out with some volume. Maybe you could take a long trade in gold. If you think the market's going to go down, gold should probably go up. They're inversely correlated. Remember I said probably. That's what gold looks like. We won't cover any of the other ones. Let's have a look, however, at oil, because oil's been an interesting case study. And here it goes. Now, this is a graphic term. I warn you guys, for those that have light stomachs, maybe you want to tune it out for a second. But right here, we call this to be a dead cat bounce, just so it's not as graphic. It's called DCB. And this week, the first couple days, when it stabilized, it was also a dead cat bounce. And I said that, probably in different terms, because it's a little derogatory. But the idea is, if a market's dropping and it looks up slightly, there's optimism here. The idea is that if a cat fell off the 7th floor, all right, on its way down, even a dead cat would take a bounce off the concrete. And that's the idea. So it's graphic for a reason. It means, yes, it's going up, but it's short-lived optimism, and it's not on the back of strength, but it's on really the back of a break from weakness. Okay? Bearish markets are ones that open bullish, okay, or open higher, and close bearish. Okay? I can't tell you how often people email me and say, wow, we had such a strong and bullish open. All right, and remember, the amateurs control the open and the professionals control the close. If a market opens strong and closes weak, the market is weak. Peter says, George, I'll email you my address so you can email my. Sure, no problem. I'll send it out to you. It's not an issue. Or we could just connect. Even though we know how that's worked in the past, We'll figure it out, Peter. You and I will figure it out. Two great minds should come up with one solution somehow. Okay, on to this. So crude oil hasn't done very well. I remember a lot of my colleagues said at $80, how could oil be so cheap? Let's buy it at 80 bucks. I laughed. All right, at $70, they said, oh, it's not going any cheaper. I also laughed. I said, just guys, hold on a second, relax. 60 bucks. People are telling me to buy it again. $50, they said that's going to be such strong support. I myself believe that it's going to pivot off here and go up to maybe 70 bucks again for a retracement. But I said, you know what? It's not ready yet. The timing's still bearish. Don't try to catch a falling knife. All right, remember that analogy. That applies in bearish markets. It's continuing its way down, and now, guys, it's below $50. And now all the same people that told me to buy gold or oil at 80, 70, 60, and 50, now they've just turned around and said, I hate oil. It's going down to zero. So maybe now it's time to buy. All right, so I'm going to keep you posted on that. I'm keeping track on oil as it develops. Promise you we're going to make some money on it. I almost feel guilty that I run a trading business and we didn't get in on this trade, but that's okay. All right, lesson learned. Especially since we're calling it. You guys remember a couple months ago, even last year, we were saying, oh, this looks like such a sweet triangle when it breaks out. And it just broke up too quickly. We didn't get a chance to get in. But you know what? At least we called it. Pat yourself on the back because being right is one fantastic feeling and it's a good thing. Next step is try to profit from being right. Okay, so there's oil, there's equity markets. There's an overview. Let's start looking at our individual trades. That concludes our equity analysis section of S&P 500, Dow Jones, US dollar, gold, and oil. Okay, do you guys have any questions for me at this point? While I click the charts and mess with your head and see if I can't give anyone a seizure. Not funny. Bad joke. Let me switch the chart here. Where did I go snowboarding? Wow, that's a little off topic. I think you guys are messing with me knowing that I get off topic really easy. Yes, there's a comment out there that says, I think oil is more fundamental movement than it is technical. I would tend to agree with that. There's a supply glut, as the media likes to call it, or an oversupply at the moment, and weakening demand out there in the market. So there's a lot of supply and demand as well. The picture's not as rosy for oil. There's a lot of political pressure as well. Saudi Arabia battles it out. Russia's now involved. There's all kinds of rumors and thoughts out there. And you know what? Maybe we'll do a webinar on oil. The black gold webinar. But I agree. And gold's really risky, or sorry, oil is really risky to trade in the futures market and the ETF because it fluctuates 24/7. When it opens in the morning, for example, it gaps really high or low. There's a lot of gaps and a lot of volatility in price action because it trades overnight. That's why we don't trade it. You might get stuck in a bad position, and it's not a good feeling. All right, let's start with our Apple stock, which I'm going to bring back to the chart here. And let's do some analysis. All right, earnings season's kicking off soon. And really, the kickoff of earnings is Alcoa. That's an aluminum producer. It's the first company to introduce earnings. Somebody asked me when earnings is, and that's why I pulled up Alcoa first. It's going to be on January 12th, so tomorrow. Holy crud, we're kicking off earnings season tomorrow. There it is, which means it's going to be a couple weeks of volatility, which means if you're trading anything, make sure you check the stock and know when the earnings is, because if you hold it over earnings, you're gambling. Okay, Apple. Let's have a look at Apple. Now we're going to review our watch list of symbols and set up our trades for the upcoming week. For our YouTube subscribers, sign up now if you want to join us for Market Analysis Live. You'll also find trading tips, tutorials, and additional analysis on our blog. Thanks for joining us. Good day and good trading.